It is April 5th, early in Friday morning, or Thursday night, whichever one you prefer. And we're sitting at an all-time high again. This is the video log that takes 30,000 to a million, by the way. And after I update you on some of the action on Thursday, we will talk about how to make money off of selling put options. So stay tuned for that. Let's jump in the browser. And here's what we're going to find out. Sitting at a pretty 55,500, a little bit over. The biggest gainers have been Apple, EXK, EDF, which is emerging markets. We got a little bit of weight in precious metals, a nice reversal here through the day. We have URG going down $43. And we have, let's bring this microphone a little closer. All right, and then that's about it. Those are the big movers. Platinum has been really climbing off of lows, so that's something to watch. I kind of chickened out of that trade a little bit, so be it. And that's about it. I have some dividends coming in, but nothing too exciting. This is the weekly graph of the account. It's gained about $1,000 over the week, 1.85%, which is not too bad. As far as new trades that have been happening, I sold this call on Apple at 197.5. So if Apple reaches 197.5, I will be forced to sell my shares, which I'm not too hot about. I don't want that to happen. But I'm not going to complain about it. I mean, I will have gained another $150 off Apple, which is great. So Apple is sitting at 196 right now. I sold it at 40, and my liability is $31 right now. So I'm sitting at a plus $11 in the trade so far. Very interesting to watch. As far as my Spotify calls, everything expired, which is great. Collected the money off of that. And Spotify continues to go down, which I should have been making more money off of it, but I'm not. Alright, so how do we sell put options for income? Well, I've done it on chemical right now, as you can see. Oh, actually, this is a call option sell, I'm sorry. I did it on chemical. I sold a put option on chemical, and then I collected the premium, but I was forced to buy chemical at $12 because it went under it, and now I've actually sold a call against that. So let me show you how that happens, right? I really like trading chemicals when it comes to options because, oops, that is not chemical, because it's a really stable stock. It's a uranium company. It's one of my favorites, and it's really stable. As you can see right here, I'll show you in a second. Look at the 3 months. It's virtually the same price. So that's the number one thing you want to identify, something that stays steady. So not something that gyrates really aggressively through time, because it's going to screw up your strategy here. Look how steady it is. It's been 15, 14. Look, ever since October 7, 2016, it's been like almost the same price. It's climbed a little bit. So that's the kind of stock you want, not something super volatile, but something with implied volatility, but not actual volatility. Implied volatility means that your stock options are going to be traded at a lot higher prices, and that's what you want, but you don't want the stock to actually be volatile. So this is great, especially the last year here has been just fantastic for chemical, just a really steady grind upwards. And I'll show you how to place a put order and what that means over here on the website, and then I'm going to show you on the phone so you can see in that interface what it looks like. So if I have the money, which I don't right now, I only have $91, and that's premium money, by the way. It used to be zero not too long ago, so I'm just collecting cash off of options. We're going to click on trade. You want to select what you want to do, which is we want to sell puts. And what that means basically is that we're going to be putting up cash and promising that we're going to be buying a stock at a certain level. So for example, these are set for April 2nd, but you can choose your date. the further out it's going to be, the options are going to be worth more, the premium is, but you're going to actually have to wait longer for the price to move, which is you're taking on more price risk over time. So let's say it's April 2nd, and I can promise to buy Chemical, which is at 11.57 right now. If I promise to buy it at 11.5, I will be rewarded $15 to do for that promise, and the option is going to expire on April 12th. So I will need a total of $1,150. You can multiply 11.5 times 100 because every options contract is traded with 100 stocks. So if I have $1,150, I will put it up as a collateral, and it's going to be held until April 12th. And then once April 12th comes in, we're gonna, the computer is gonna determine, unless you trade the options prematurely, let's say you wait till expiration, the computer is gonna determine, oh, is the stock price under $11.50 or over $11.50? In the case that it's over $11.50, what's gonna happen is the computer is going to give you your collateral back, and you have already collected your $15, 15 cents times 100. And so you get $15 into your account, and you get your $1,150 collateral released, and it's also going to show up in your account. And if you had $0, you're now going to have $1,165 instead of $1,150. So you've basically earned $15 for taking on that risk until April 12th, in a little bit over, it's exactly a week actually. And that will be your reward, which is not bad. It's like 1%, a little bit over 1% for a week's worth of risk. Now, what you want to do is you want to trade companies that you like, because if you happen to have to buy those shares, right, if the price drops below $11.50, you're going to be forced to buy the shares at $11.50, which is below the current price, but it's going to be above what the price is going to be then. So but you still get to collect that $15 premium. So now let's say the price drops all the way down to 11. You're going to have to buy it at 11.50. But you know what? You like this company anyway, so you're just looking to accumulate shares in the company, so it works out well for you. If the price keeps dropping, well, you know what? That's too bad. You still get to collect your premium. Maybe now, what I've done with Chemical, actually, I just did that with my previous put sell. I sold at $12. It dropped below $12. It's exactly what happened. And now I was forced to purchase 100 shares at $12 each. Fine. And now what I did was actually sold a call against those shares at $12 again to collect premium. And in case they reach $12, I'm going to be end up having to sell those shares again. But I get to collect premium both ways. So let me show you over here now what it looks like on the app. So I'm entering my phone app right now. This is what it looks like. Oh, it's superb. I don't know if it's very clear, but let's say we wanna work on Apple. Oh, okay, there we go. This is what the app looks like. It's pretty cool. So let's say we wanna trade Apple. So once we click Apple here, this is it. You gotta click this button here, right? Zoom. It's not very visible, but it's called trade. And then hopefully, let's see if, there we go. It says trade options up at the top. You click trade options, and now you can choose your date. Let's see if I can click it. This is more challenging than I thought. There it is, the April 12th. And then we're going to choose sell put. Actually, it's already showing sell put here. And then you get to choose, at what price. So if I want to, I know it's a bit blurry, but, that's tough. If I want to sell a put for Apple at 195, maybe you can see it, maybe you can't. It's not really making it clear. Oh well. It says $3. I'm sorry, it's $2 exactly. So if I want to sell um, a put for Apple at $195, it's the current price is 196.05. Then I'm going to be rewarded, $200. But Apple is an expensive stock, so that's why. But I'm promising basically, what's going on here? Trump picks ex pizza exec for Fed seat. Great. Thanks, Yahoo Finance. So I'm going to be rewarded. Oh, there we go. $200. You can see clearly now. If I sell a put for Apple at 195, it's currently at 196 by April 12th. So if the stock goes up, I'm going to collect that 200 outright. And if the stock goes down, I'm going to be forced to buy it at 195 each. So I need to have $19,500 worth of collateral ready to exercise that option. All right, so that's how the put options work. And yes, if you have 20K, you can be collecting roughly $200 per week from trading options. And now you can just select one or two, and it tells you like how much everything's gonna cost. All right, it's gonna give you a minimum credit of, well, basically it's gonna give you $200 credit. I'm not gonna execute that right now because I don't even have the money in there to do that. But if my call triggers on Apple, then I will have that money because Apple will have sold at $197.5, right? So that's how you sell put options, and it's a really interesting way of accumulating shares. You can think of it as accumulating shares at a lesser price than you would pay today, right? Because if Apple costs 196 right now at the 12th, if it costs, but I don't want to pay 196, but I'm willing to pay 195, I can get rewarded for my time for waiting for that price to happen. Or if that price does happen and drops below, I will be buying at 195, and I will be collecting premium for my time for waiting. So it's a really good way to accumulate cash or stocks, but I definitely recommend doing it with stocks that you like. Like, I wouldn't do it something risky, something you don't looking to accumulate, because if the price drops and now you own a stock that you don't like or you don't want for a price that's lower than what you paid for it, you may want to sell it, you may want to get rid of it, and it just becomes more of a gamble rather than stock accumulation tactic. All right, so make sure you like the stock and you saw how the process works. It's pretty simple. And it's also a good way to trade options because most people buy options because it's easy to understand, right? Buy a call if you want stocks to go up and profit from that, buy a put. But really, the time decay works against you when you do that. The stock, the option is a depreciating asset, and you'd rather have time work for you rather than against you when you're trading stocks. Now, obviously, there's risk in everything, and there's a lot of stock option traders on that side of the trade as well. And you may keep getting killed by volatile stocks and having to buy stocks that are overvalued and sell stocks that are undervalued, etc. But it's part of the game. You have to know what you're doing, and I would suggest, like, if you really want to try it, start with a stock you like that's really low priced. Just put up some cash up front, as collateral, and start selling puts against it. Maybe start selling a call against it once you buy it at a higher price, and see if you can make some money that way. Again, of course, I'm not a financial advisor. You got to do all the stuff with your own risk, and make sure you have the money to lose in case something does go wrong. Like, I wouldn't trade on Robinhood with any money that you're not willing to lose to begin with. So make sure you understand those risks. But that's how you do it. This video was actually encouraged by my man Durf the guy who comments for on the video. So hope you enjoyed that. It was kind of long-winded, but I repeated it a few times. I took it on a few different angles. So hopefully you guys understand how that works a little bit better. And good luck to y'all. I think that's it for now. Peace out.